We've just witnessed chaos that rattles the foundation of the markets. Silver, the silent workhorse of industry and wealth, has plunged nearly 10% in a single day. Screens are painted red. Algorithms whir into panic mode. Hedge funds are liquidating assets faster than the eye can follow. This isn't a correction. This is a liquidity crisis, a raw, unfiltered scream from the financial system, where survival trumps value. Imagine billions of dollars evaporating in moments. Gold, the world's oldest safe haven, has cracked under the weight of fear. Retail traders panic. Stop losses trigger like dominoes. And yet, the industrial demand hasn't vanished. The solar panels still need silver. Batteries still need it. It's not the metal itself that's failing. It's the system. Tonight, we dive into the anatomy of this collapse. The margin calls, the algos, the domino effect from bonds to gold to silver. We'll reveal why today's carnage might secretly be the opening act for the next massive rally. This is a market where the strong survive, the leveraged fall, and every crash hides the seeds of the next boom. Hold your breath. Stay sharp. And understand, the chaos you see is the story of money in motion, and it's only just begun. The screens went red, fast, too fast. In a heartbeat, billions of dollars vanished from the silver market. $72, $75, down $6.50 in a single session. Over 8% gone. But this was not panic selling by everyday investors. No, this was something far more terrifying. Institutions were liquidating, not what they wanted, but what they had to. The rules of survival in a margin call are ruthless. Imagine Fund X, a massive hedge fund, long on silver, gold, and bonds. Everything seemed stable until the bond market wobbled. Suddenly, a broker's call. $5 billion, end of day. The panic spreads. Bonds cannot be sold fast enough. Private equity, too slow. What remains? Gold, silver, the most liquid assets. Now, with one click, billions flood the market. The price collapses. The shockwave hits paper silver first. Why? Because it's smaller, thinner, and more sensitive. Gold's fall is the smoking gun. $156 down in hours. A 3.5% drop may sound modest, but for the most stable asset on Earth, it screams distress. When gold moves like this, the system trembles. Scientists like Dr. Nouriel Roubini have warned, sharp moves in top-tier assets signal systemic stress. This is not a market correction. This is a liquidity scream. Algorithms join the chaos. Trend-following bots, programmed to chase momentum, accelerate the fall. They don't care about supply chains, industrial demand, or Samsung needing silver for batteries. All they see, price below threshold. Sell, sell, sell. The Cascade overshoots reality, dragging paper silver far below the physical market. Meanwhile, the US dollar surges. DXY spikes, banks hoard cash. Traders scramble. Deflationary shock hits. Every asset, except cash, trembles. The very lifeblood of the system, liquidity, is momentarily frozen. Margin calls compound. Retail traders caught in the storm panic. Stop losses trigger. Selling begets selling. It's a brutal chain reaction. Yet beneath the chaos, a hidden truth emerges. Physical silver remains scarce. Dealers report premiums soaring 14% above spot. Arbitrage whispers to the global market, the floor is solid. The paper market crashes, but the tangible reality holds. This invisible cord promises a rebound once the liquidity tap opens. Central banks have done it before, in 2008 and 2020. And they will do it again. The stage is set. The crash is not the end. It is a cleansing, a reset. But how low will it go before the bottom arrives? 70, 68. The countdown begins. Every tick of the clock matters. Because in the world of margin call havoc, survival is for the patient. An opportunity hides in the shadow of panic. The first sign wasn't silver, it was gold. Think of gold as the canary in the financial coal mine. Miners once brought actual canaries into underground tunnels. If toxic gas filled the shaft, the bird fell first. So it is with gold. When the price drops sharply, it signals unseen stress. Banks, bonds, and even global credit lines are trembling. Harvard economist Kenneth Rogoff calls it a liquidity thermometer. Why does gold fall before the chaos spreads? Because institutions sell what is liquid, what has global demand. Gold's market cap is roughly $59 trillion. When even a fraction is offloaded, it shakes confidence everywhere. The bond market trembles. Loans called, hedge funds panic. Silver feels the shock, but gold is the alarm bell. The mechanics are brutal. U.S. Treasury yields spike. Collateral values collapse. Banks need cash. Gold is liquid, trusted, universally accepted. So it moves first. And when gold moves violently, algorithmic trading triggers automatic sales across correlated assets. Within minutes, the paper market erupts. It's a domino effect, a cascade of distress signals that no human can stop in real time. And yet, there's a hidden paradox. Physical gold doesn't disappear. Central banks, sovereign wealth funds, and private hoarders continue to hold. The paper price moves, but tangible demand is unbroken. Analysts at the World Gold Council report central banks added over 1,100 tons in 2023 alone. The floor is solid. The panic is largely artificial, a reflection of liquidity pressure, not fundamental collapse. As the dollar spikes, the deflationary pulse intensifies. Traders scramble for cash, equities tumble, bonds wobble. Gold leads the charge, showing that the system itself is under stress, not just the commodities. The Canary is coughing, and the miners, bankers, and policymakers are watching every twitch. Every tick matters. Will gold hold 4,000? 250? Can it reclaim $40,400? Each level crossed is a heartbeat of the system. Central banks, once silent, may intervene, printing liquidity to stabilize the shock. History shows that gold's fall precedes recovery and often signals the magnitude of the rebound. The question looms: are we witnessing a temporary scream for cash or a deeper systemic tremor? Investors and institutions alike stare at the gold chart, knowing that what happens here dictates the fate of silver, equities, and credit markets around the globe. Gold is speaking. Will you listen? The answer will define the next 48 hours in the most watched markets on Earth. The market doesn't just crash, sometimes it explodes. And today, it wasn't humans, it was machines. Trend-following algorithms built to hunt momentum turned silver's fall into a mechanical massacre. Imagine billions of dollars moving not by choice, but by code. Computers don't care about fundamentals. They don't care about Samsung needing silver for batteries or China hoarding for industrial demand. They follow patterns. They follow signals. And today, the signal screamed, sell. For weeks, silver was rising. Algorithms were long. They bought every dip. They fueled the rally to $83. Then, one sharp break, a margin call somewhere in the bond market, triggered gold to fall $156. That cascade hit silver like a lightning bolt. Algorithms detected the break-in trend. In milliseconds, the rules flipped. Orders executed automatically. Billions of dollars of paper contracts dumped in seconds. It's called a cascade because it feeds on itself. One machine sells, another detects the drop, another triggers a sell signal. Within moments, a single event multiplies into a tsunami. Humans try to intervene, but by the time a trader reacts, the price has overshot fundamentals. The market dives far below where physical supply and demand suggest it should be. Consider the numbers. Silver fell 8% in hours. Gold fell 3.5%. A simple mechanical reaction multiplied volatility. Traders call it beta amplification. It's not emotion, it's math. CTA funds, or commodity trading advisors, rely on this mechanical discipline. MIT researchers studying high-frequency trading describe it as a self-reinforcing destabilizer during stress events. Yet the human eye sees opportunity. Physical buyers, savvy investors, watch the paper price disconnect from reality. The New York spot market crashes, while premiums on coins and bars remain elevated. Dealers in Shanghai pay $8 more per ounce than the NY paper price. Arbitrage opportunities appear. Physics clashes with code. Supply cannot be created fast enough. Paper crashes. Physical holds strong. The tension builds. Every second counts. Every tick feeds the algorithm. Every human decision is delayed by milliseconds. The cascade creates panic, fear, and awe simultaneously. The market feels sentient, but it is not. It's a machine following a set of rules designed for calm markets, now weaponized by chaos. And yet, history provides hope. Every algo cascade eventually exhausts itself. Liquidity returns. Central banks inject capital. Human logic reasserts itself. Paper overshoot corrects. Physical reality wins. The silver floor remains intact. The V-shaped recovery is waiting, just beyond the mechanical madness. The question is simple. Can humans hold the line while robots tear through paper contracts? The answer will determine whether today is a momentary purge or the trigger for a historic entry point in silver. The cascade has begun, the machines are running, and the clock is ticking. As silver tumbles and algorithms scream, another force silently reshapes the battlefield, the US dollar. In times of panic, cash becomes king. Not just any cash, but the world's reserve currency. Every bank, fund, and trader suddenly wants the same thing. Liquidity, dollars, fast. The DXY, the US dollar index, spikes. Not gradually, not politely. Like a hammer striking metal, it surges 1%, then 2% within hours. For silver, this is catastrophic. The commodity is priced in dollars. Every greenback gained by the dollar is a drop in silver's paper value. The stronger the dollar, the further silver falls, an inverse mirror of panic. Why does this happen? Imagine a global system interconnected like a web. European banks, Japanese funds, Middle Eastern sovereign wealth. Suddenly all scrambling for dollars to cover margin calls, settle trades, and meet short-term obligations. They liquidate foreign assets, sell bonds, dump commodities, and the dollars flood home, rising against everything else. The liquidity vacuum is brutal. A $5 billion margin call in London sparks $50 billion of liquidations worldwide. Stocks fall, oil drops, gold slides, silver plummets faster. The velocity of money becomes a weapon. This is not a correction. This is a deflationary shockwave. Historically, we see this in action. In March 2020, during the pandemic crash, the DXY surged 6% in days. Silver collapsed from $18 to $12. But the physical demand didn't vanish. Hedge funds were selling paper, not metal. Dollars were hoarded. And when central banks intervened, $3 trillion injected into the system, the paper price snapped back. The V-shaped recovery is the aftermath of dollar-driven panic. Today, the dynamics are similar but amplified. Every uptick in the dollar triggers another round of liquidation. Automated systems detect dollar strength and sell commodities. Margin calls cascade further. The silver screen goes red. Emotions spike. Fear spreads like wildfire. Yet, amid chaos lies strategy. Savvy investors watch the dollar's peak as a signal. When the DXY reaches extreme levels, panic often nears its climax. This is the moment the Fed, or other central banks, step in to restore liquidity. Dollars flow back into the system. Paper overshoot corrects. Commodities rebound. Silver climbs as cash surges into undervalued assets. The dollar is both predator and guardian. It destroys paper prices while setting the stage for recovery. Timing is everything. Watch the DXY closely. Every tick could signal the difference between panic selling and strategic buying. The machines are selling, the banks are hoarding, and the dollar, it swings like a wrecking ball through global markets. The countdown is on. How long until liquidity returns? How deep will silver fall before the floor is revealed? As screens flash red and charts scream, a curious phenomenon quietly unfolds beneath the chaos. The divergence between paper silver and the physical metal. On one side, contracts, futures, and ETFs are crashing. On the other, actual ounces. The coins, the bars, the tangible silver you can hold, refuse to follow. The markets appear broken. But physics is still undefeated. In New York, paper silver plunges $6, an 8% collapse in a single session. But walk into a dealer's shop and the story is different. Generic rounds are selling at $10 above spot. Coins, bars, and small ingots carry premiums as high as 14%. The supply isn't gone, it's scarce. The paper market is liquid, the physical market is finite. And this tension is where opportunity hides. Why this happens is simple yet dramatic. Hedge funds and institutions liquidate silver to meet margin calls. Algorithms amplify the panic. Contracts fly off the books. The paper market collapses, disconnected from reality. Meanwhile, industrial demand hasn't vanished. Samsung batteries still need silver paste. Solar panels still require it. Jewelry makers still mint rings. The real-world demand is relentless, immutable, unyielding. China acts as the ultimate arbitrage engine. When New York prices dip, the gap to Shanghai premiums grows, sometimes $8 per ounce or more. Traders recognize the opportunity immediately. Cargoes move east, physical silver leaves the west, and the arbitrage gap tightens like a rubber band. The lower the paper price falls, the higher the tension builds. Eventually, the floor snaps into view. Historical echoes reinforce the pattern. During the March 2020 flash crash, paper silver fell 30%, yet premiums for physical silver doubled. The metal didn't vanish, it simply resisted the panic. When liquidity returned, prices didn't just recover, they soared, catching short sellers and panic liquidators off guard. History repeats in cycles. Physics eventually wins over speculation. Psychology plays a crucial role. Retail investors, panicked by flashing red numbers, often misinterpret the crash as a fundamental collapse. They sell into weakness, missing the deeper reality. Meanwhile, those holding physical metal sit patiently. Their wealth remains intact, insulated from margin calls and algorithmic liquidation. The invisible line between paper and reality becomes a battlefield of perception versus substance. This divergence also signals broader market truth. Silver's foundation is real, finite, and industrial. The paper market is artificial, amplified by leverage and liquidity pressures. Watching premiums and physical flows provides a secret window into true market strength. The metal refuses to disappear. Its scarcity is the hidden floor beneath the storm. And so, as panic grips screens and algorithms scream, one question dominates. How far can paper prices fall before the physical floor asserts itself? The answer holds the key to survival and the next major rally. The storm hits first, red candles engulf the charts, margin calls force liquidations, algorithms scream selling what humans wish they could hold. The panic is instantaneous, brutal, and merciless. But history teaches us a secret. Liquidity crises are short-lived, sharp, and often followed by a violent rebound. This is the recovery window. Think back to March 2020. Silver plunged from $18 to $12 in a single week. 30% gone. Panic reigned. Hedge funds sold to cover losses elsewhere. Retail traders froze, yet within 5 months, silver had not just recovered, it doubled. $12 became $30. The lesson is clear. When liquidity returns, the oversold asset explodes higher. The mechanics are simple, almost surgical. Central banks intervene, dollars flood the system, collateral stabilizes. The frozen markets thaw, and the assets that were punished hardest are often the first to rebound. Why does this happen so predictably? It's a combination of necessity and psychology. Banks cannot survive prolonged collateral failures. Governments cannot let debt chains collapse. Central banks, from the Federal Reserve to the European Central Bank, are forced to act. Rates are cut, swap lines open, and liquidity pours in like a rising tide. The panic sellers are exhausted. Weak hands are out. The market is lighter. And into that void step the deep-pocketed investors, the pension funds, and the value buyers who recognize that fundamentals haven't changed. Timing is critical. Recovery windows are measured in days, sometimes a week or two. Too early, and the market is still in shock. Too late, and the rebound has already begun. Observers watch signals carefully. Gold stabilizing above $4,400, the US dollar easing, dealer premiums holding firm, and industrial demand continuing unabated. These markers tell a story invisible on the screen. The system is healing. And when the rebound begins, it is often a mirror image of the crash. If silver fell 8% in a day, it can rise 8% just as quickly. The V-shaped recovery is not speculation, it is physics, psychology, and policy converging. Paper contracts soar, short sellers scramble to cover, and physical demand exerts invisible upward pressure. The same forces that drove the panic now fuel the surge. For investors, the recovery window is both a risk and an opportunity. The crash was painful, yes, but it reset the market, removed froth, and created a launchpad for the next leg up. Patience becomes power. Holding through the storm is not just endurance, it's positioning for outsized gains. The countdown begins. Within days, the liquidity tap will turn on, the oversold asset will awaken, and the market will pivot. Will you be ready to witness the rebound, or will you have sold before the rocket even launches? The storm has passed, or has it? The markets have trembled, silver fell, gold stumbled, algorithms screamed, but this is only the prelude. You've seen the mechanics, you've felt the panic. Now the real story is about to unfold, the recovery, the arbitrage, the opportunity hiding in plain sight. If you want to stay ahead of the chaos, if you want to understand the forces moving silver, gold, and global markets before anyone else notices, this is the moment to act. Subscribe now, hit the bell. Don't wait for the headlines to tell you the crash is over. Be the first to see the V-shaped recovery unfold. Be the investor who watches while others panic. This isn't just another market update, it's a roadmap to survival, and potentially massive gains. Don't miss the next chapter. Your future portfolio depends on it. The countdown is on, the liquidity tap is about to turn. Will you be ready when the markets pivot, or will you watch from the sidelines as opportunity explodes? Subscribe, stay alert, and hold tight. The next move could change everything.